Hi everyone, welcome to my channel. In this video, we will see the difference between futures and options. Futures and options are financial derivatives that allow investors to hedge the risk or speculate on the price movements of assets, but they have distinct characteristics and uses. Here are the key differences between futures and option. Obligation versus rights. A future contract is an agreement between two parties to buy or sell a specific quantity of asset at a specified price on a future date. Both the buyer and the seller must fulfill their responsibilities, that is, obligation in the contract. An option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price known as the strike price on or before the option's expiration date. If the buyer chooses to exercise the option, the seller must fulfill the terms of the agreement. Buyer has rights, seller has obligation. Future and option contracts are bought and sold on a regulated stock exchanges like NSE and BSE. We can trade these contracts through approved brokers such as Zerodha, Dan, and Alex Blue. We can buy and sell futures and options on the following assets: financial instruments such as stocks, that is, Reliance, ITC, etc., stock indices like Nifty, Sensex, bonds and currencies, and commodities like crude oil, gold, wheat, and coffee. Example of features and option in Zerodha Kite Web. Here you can see the Nifty 50 index. This is the index, so we cannot trade. Similarly, you can see the Nifty Bank index, so we cannot trade here as well. So the next three symbol is features. This is March month feature, that is the current month features. This is April month feature, and this is the May month feature. Similarly, you can see the options symbols here. The Nifty 50 current market price is 22,397. So the nearby strike is 22,400. So I have taken the call and put options over here. Here, if you click the depth, you can see the list of buyers and sellers. Here now market is closed, so we cannot see. For example, in future, a seller agrees to sell 75 units, that is one lot of Nifty futures, to a buyer at the current price of rupees 22,444.25 for delivery in 1 month. Both the seller and the buyer must follow through with the deal, no matter what the market price is at the time. In option, a person buys a call option for 75 units, that is one lot of Nifty at the price of 140. With the option expiring in a week, the buyer has the right but not the obligation to buy the Nifty at rupees 140. If the price goes above rupees 140, the buyer can exercise the option. If the price stays the same level or goes down, the buyer can let the option expire without buying the option. Second one, risk and reward. In a future contract, both the buyer and seller are exposed to unlimited risk. The buyer faces the risk of the asset's price falling, while the seller faces the risk of the asset's price rising. The buyer of an option has limited risk, that is, the premium paid for the option, and unlimited profit potential. The seller of an option has limited profit potential, that is, premium received, but faces unlimited risk if the market moves against them. Upfront cost structures. No upfront premium is paid when entering a future contract. Instead, both parties are required to deposit margin money as initial deposit, that is, security deposit, to ensure they can fulfill the contract. Option buyers have to pay an upfront fee, that is, premium, to the seller for the right to buy or sell the asset. The seller receives this premium but must maintain margin requirements. Profit and loss. In future contract, profit and loss is calculated on a daily basis, that is, mark to market, and settled at the end of each trading day. In option contract, profit or loss is calculated based on the price differences and is realized only when the option is exercised, expires, or is sold. The buyer can choose not to exercise the option if it is not profitable. Next one, flexibility. In future contract, less flexible because both parties are obligated to fulfill the contract at expiration. Less flexibility because of obligation. In option contract, more flexible because the buyer can choose whether to exercise the option, let it expire, or sell it before expiration. More flexibility has its rights. Next difference is purpose. The future contract is commonly used for hedging against price fluctuations in commodities, currencies, and financial instruments, as well as for speculation. The option contracts are used for hedging, speculation, and generating income. That is, strategies like selling covered calls. Expiry date. Future contracts have a fixed expiry date, so the holder must execute the contract at expiry regardless of market conditions. The asset must either be bought for physical delivery or sold at predefined date using the cash settlement. Option contracts also have an expiration date, but the buyer can choose to exercise the option before expiration. It can happen anytime before the contract expires. An option buyer has the choice not to exercise the contract if the market moves against their position. In summary, features are binding contracts with symmetric risk, while options provide asymmetric risk profiles and greater flexibility for the buyer. Thank you.